Imagine opening your Darking app today and seeing like a 1 followed by 12 zeros.
And as of today, that is actually not a software glitch.
No, it's very real because as of this morning, Friday, June 12th, 2026, history has officially minted its very first trillionaire. Elon Musk's net worth has crossed this threshold that economists honestly use to treat as purely theoretical, driven entirely by the record-shattering SpaceX initial public offering.
The market mood today is just entirely anchored to that single concrete number. I mean, we're witnessing a massive accumulation of capital, but the raw numbers only tell a fraction of the story. The underlying mechanics of how this wealth was just engineered are fundamentally shifting how markets operate.
So for you listening, our mission today is to unpack those exact financial mechanics. We're going to look under the hood of this SpaceX mega IPO to see how it bends the traditional rules of investing. And then we'll look at how the 2026 World Cup, which just kicked off, is testing a radical, highly aggressive new pricing model on sports fans to extract that exact tier of wealth.
Plus, we need to reveal the sort of invisible levers that everyday retailers are quietly pulling behind the scenes to keep you spending when the economy tightens.
Because the through line connecting all these events is market engineering. So let's actually look at the math on this SpaceX debut, because the numbers coming out of the NASDAQ today are just absurd. I mean, over 500 million shares exchanged hands in the opening session alone.
The raw data is wild. Shares priced at $135, but they opened at $150, and then they closed near $161. That momentum pushed the company's total valuation past $2 trillion.
Which puts Musk's resulting $1.05 trillion net worth into a perspective that's almost hard to grasp. It's larger than the national GDP of Sweden, Taiwan, or Ireland. He is now worth more than the next 5 richest billionaires combined.
But the valuation itself invites some serious analytical skepticism. I mean, a $2 trillion market cap implies a staggering 40 times multiple on estimated 2026 revenues.
Wait, let's unpack that for anyone who, doesn't spend their days looking at financial statements. A company usually trades at a multiple of its profits, or maybe a low multiple of its total revenue. Trading at 40 times the money you actually bring in means the market is pricing in decades of flawless, exponential growth.
It's pricing imperfection.
Which means, since this valuation includes futuristic goals like human colonies on Mars, are retail investors actually buying a commercial space company, or are they effectively crowdfunding a science fiction movie timeline?
Well, I wouldn't call it science fiction anymore. The market is pricing in the infrastructure for the next industrial revolution. I mean, SpaceX is no longer just launching reusable rockets to supply the space station. They are actively deploying AI data centers in orbit.
Because that completely bypasses the massive terrestrial constraints on power grids and cooling systems here on Earth.
Exactly why they have massive multi-billion-dollar commitments from Google and Anthropic for this orbital compute space.
So investors are basically buying into the servers, not just the rockets. But what makes this offering mechanically unique is the retail allocation. Typically, an IPO reserves maybe 5 to 10% of the shares for retail investors, everyday people using Robinhood or Charles Schwab. Institutional buyers, like massive pension funds, get the rest.
But for this offering, SpaceX opened up over 20% to the public. And that introduces a completely different, highly volatile market pressure.
Because usually a company has to season on the public market for months before being added to major tracking indexes like the S&P 500 or the Russell 1000. They have to prove their stock is stable, their reporting is clean, and they won't collapse in week 2.
But major index providers are currently being pressured to fast-track SpaceX into their funds. Under the relaxed rules currently being debated, SpaceX could be added to major indexes in as little as 5 trading days.
Wait, if they fast-track SpaceX into those indexes, that affects almost everybody listening to this. If I have a standard target date retirement fund or a passive S&P index fund in my 401k, my portfolio just buys whatever is in the index.
Your 401k might automatically convert a portion of your retirement savings into SpaceX stock by next Wednesday, regardless of whether you actively choose to back an AI satellite network. The sheer size of a $2 trillion company means index funds cannot afford to ignore it without their tracking metrics breaking down completely.
So millions of passive investors will become partial owners purely by default. But let's shift gears to what I think is the most fascinating human element of this entire IPO, the secondary market dynamic among SpaceX's own workforce. This IPO just minted thousands of new millionaires and several new billionaires among the employees.
But instead of taking standard financial advice, These aerospace engineers are treating wealth management like an aerospace engineering problem. You have over 100 engineers pooling between $1 and $5 billion in combined liquid assets.
They are taking this massive syndicate of capital and approaching registered investment advisors like the firm Corio with extreme demands. They are essentially unionizing their wealth to negotiate sub-industry management fees down to 0.5%.
By moving as a single multi-billion-dollar entity, these employees bypass the friction of standard financial fees. And they are bringing artificial intelligence directly into the boardroom to challenge these advisors.
Which has to be terrifying for the advisors. I mean, they are reporting that these newly minted millionaires show up to wealth management meetings with output from Anthropic's Claude or OpenAI's ChatGPT. They put complex estate planning structures and tax strategies up on a whiteboard and aggressively stress test the financial products.
So an advisor pitches a standard charitable remainder trust, and the engineer runs the math through an AI model in real time, finds a tax inefficiency, and points it out on the board. They are troubleshooting financial products just like they would troubleshoot a faulty rocket booster.
Which signals a major shift in leverage. When capital is that concentrated, the owners of the capital dictate the terms of the financial services they consume, rather than accepting the off-the-shelf rates.
So SpaceX's engineers are literally building unionized fortresses to protect their new wealth.
But while they are playing defense, global mega brands are actively building machines to extract that exact tier of wealth. Let's look at what FIFA is doing right now with the 2026 World Cup, which, just kicked off across the United States, Canada, and Mexico.
The economic shift of this tournament is a masterclass in aggressive yield management. Historically, host nations built massive, taxpayer-funded stadiums for the World Cup. And these often became abandoned white elephants after the tournament ended, leaving the local taxpayers with a multi-decade bill.
Like the $300 million stadium built in the middle of the Amazon rainforest for the Brazil World Cup back in 2014, which barely sees any use today.
But for 2026, FIFA altered the blueprint entirely. They have rented existing American football stadiums.
And by renting existing NFL stadiums, the financial burden shifts completely from the host taxpayers directly to the attendees. The mechanism FIFA is using to extract that value from the fans is wild. Instead of fighting ticket scalpers, FIFA simply internalized the secondary market. Let's walk through how this actually works.
The mechanics are designed to capture every dollar of hype. Fans can relist tickets on the official FIFA platform for absolutely unlimited amounts. When that secondary transaction happens, FIFA takes a 15% cut from the buyer, and they take another 15% cut from the seller.
Wait, let me make sure I'm following this. If I originally buy a ticket for $200 and demand spikes, so I resell it on their platform for $1,000, FIFA takes $150 from me. Then they charge the new buyer an extra $150 on top. They are double dipping on the markup.
They capture a 30% premium on the spread of every single resale. They eliminated the black market by becoming the monopoly scalper.
It's as if the New York Stock Exchange suddenly decided to become the world's most aggressive day trader, capturing a massive premium on every single emotional transaction instead of just facilitating the trade. How are fans not rioting over this?
Well, the dynamic pricing model is expected to push total ticket and hospitality revenue past $7 billion. That's a massive leap from the roughly $900 million generated in Qatar. To understand why fans tolerate this, we have to look at the K-shaped economy.
Well, and for those who haven't taken a macroeconomics class lately, the K-shaped economy basically means the top branch of the K, the wealthy, keep going up and accelerating their spending, while the bottom branch goes down and struggles with basic inflation.
You have two completely different consumer realities operating simultaneously. FIFA's pricing model exclusively targets that upward line. They're treating live sports strictly as a luxury asset for the demographic that possesses immense disposable income. The people buying these secondary tickets are not price sensitive.
But the ripple effects on the average consumer, the bottom leg of that K, are absurd. If you are listening to this and wondering why your local transit costs suddenly spiked, this is why. Because FIFA is not subsidizing local infrastructure, the costs are being passed down.
Take the state of New Jersey, which is hosting the final. FIFA requires massive security and transit overhauls, but keeps all the ticket revenue.
To cover the operating costs to MetLife Stadium, New Jersey originally hiked the standard $12.90 train ticket to an astonishing $150.
They eventually faced severe public backlash and dropped the train fare to $98. But even at $98, the local taxpayer and the everyday fan are bearing the operational weight of a private luxury event.
This reflects a fundamental change in the economics of global events. The priority is revenue maximization over broad accessibility. The NFL model of yield management, where seating is artificially limited, every game is treated as scarce, and corporate luxury hospitality is prioritized, has been seamlessly overlaid onto the world's most popular sport. You are subsidizing the infrastructure so billionaires can trade $1,000 tickets on a closed platform.
It creates a fascinating contrast. You have SpaceX engineers hacking the wealth management industry to save 0.5% on their billions, while FIFA engineers an entirely new market to extract thousands of dollars from sports fans.
Before we look at how everyday retailers are pulling hidden levers to survive this exact same divided economy, a quick reminder that you can find financial candy, brain candy, and classic audiobooks at claireandhoratio.com.
Bringing our focus to the broader retail sector, the World Cup is testing the absolute ceiling of what high-end consumers will pay. But everyday retailers are quietly battling over what the rest of the consumer base can actually afford. They are using completely different, highly opaque financial levers to keep foot traffic moving.
We are seeing retailers report wildly different strategies to survive the current economic squeeze. Look at Costco. They just reported their top 5 gas volume weeks in history for the period ending in early May. Drivers are aggressively hunting for cheaper fuel amid rising prices and macroeconomic uncertainty.
Costco uses cheap gas as a literal loyalty engine. Gasoline is a low-margin, sometimes zero-margin product for them. The fuel brings first-time members onto the property, and their internal data shows those members inevitably end up inside the warehouse buying higher-margin goods like electronics, bulk groceries, or clothing.
It is a closed-loop system designed to capture the cost-conscious shopper and build a physical habit. They sell you cheap gas, so you buy a high-margin rotisserie chicken and a television.
On the complete other end of the spectrum, apparel giant Lululemon just slashed its 2026 outlook and cut their earnings guidance by more than $1 per share. They publicly blamed negative media commentary and a few bad product launches, like a poorly reviewed line of leggings, for their declining foot traffic and falling sales.
But the underlying financial reality for Lululemon has very little to do with bad public relations. They lost a lucrative duty-free shipping provision known as the de minimis exemption. Let's explain how that loophole actually worked, because it is crucial to understanding their drop.
Under the old de minimis rules, a company could ship a package worth less than $800 directly from a foreign warehouse to a consumer in the United States and pay absolutely zero import taxes. Lululemon relied heavily on that provision, shipping massive amounts of inventory from fulfillment centers in Canada directly to U.S. shoppers tax-free.
Recent regulatory shifts effectively closed that loophole. Now, Lululemon is being crushed by the standard tariffs they previously avoided. The math is brutal. Those new import taxes drove a staggering 4.1 percentage point drop in their gross margin.
A 4% drop in gross margin for a premium apparel brand is a catastrophic hit to profitability. To compensate for the drop in traffic and the suddenly higher costs, Lululemon is being forced to heavily discount their clothes to clear out the excess inventory.
But for a brand built entirely on a premium full-price identity, being forced into the discount game erodes their core brand equity. They are pulling the markdown lever out of sheer desperation to generate cash, not as a calculated strategy.
Compare that desperate markdown strategy to companies like Gap and Kohl's. They are operating from a completely different playbook, utilizing a hidden corporate mechanism we can call the tariff refund war chest.
This is one of the most brilliant, invisible financial maneuvers happening right now. How does a company suddenly get a refund on tariffs they already paid?
Following recent Supreme Court rulings that invalidated certain import levies charged over the past few years, companies realized they overpaid the government. They have subsequently applied for massive refunds from Customs and Border Protection.
We are talking about staggering amounts of cash quietly flowing back to these corporations. Kohl's is currently waiting on $190 million in eligible returns. Gap is expecting an $80 million benefit. But they are not just booking this as pure profit to make their quarterly earnings look better for Wall Street.
They are explicitly holding this cash in reserve. It acts as an economic shock absorber. Gap's chief financial officer stated on a recent call that they are reserving half of that $80 million to account for higher fuel and supply chain prices.
And they're holding the other half in reserve specifically in case they need to dial up promotions to stimulate demand later in the year. It is basically a financial shock absorber.
Think of it like a retailer finding a massive multi-million-dollar gift card in their winter coat pocket from 3 years ago. But instead of spending it on dividends or stock buybacks, they're keeping it in their wallet, just in case they need to bribe you to buy their clothes next month.
It is a shadow economy operating just beneath the price tags on the rack. You walk into a store, you see a 30% off sale, and you assume it is just a seasonal promotion or a clearance event.
In reality, that specific discount is being directly subsidized by a government tariff refund check sitting in a corporate reserve account. They are deliberately hoarding capital to artificially lower prices if the consumer taps out.
Which brings us back to the overarching pattern we are seeing today. We started by looking at the highly visible, clean math of a trillion-dollar fortune minted on the NASDAQ, but the actual reality of the market is from these hidden, murky levers pulling the strings behind the scenes.
From aerospace engineers deploying artificial intelligence to hack the wealth management fee structure, to FIFA transforming itself into a monopoly ticket scalper to capture secondary market premiums, to retail giants hoarding government tariff refunds to manipulate future clothing discounts.
The architecture of pricing has never been more opaque, even as the numbers get exponentially larger. It leaves you with a fascinating question to consider the next time you interact with the economy. When you pay a wealth management fee, buy a train ticket to a stadium, or grab a heavily discounted sweater off the rack, how many invisible pricing algorithms, closed tax loopholes, and hidden financial reserves are you interacting with without ever knowing it? We are all subsidizing these massive financial engineering projects, usually without our consent. That's Financial Candy for Friday. We'll be back on Monday. And if you need something to keep you sharp over the weekend, check out Brain Candy or Debate Candy for some great weekend listening.